Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the program today is Chief Executive Officer of GoviEx Uranium. His name's Daniel Major. Daniel, welcome back to the program.
Thank you very much, Colin. Appreciate it.
I think a good way to start here is just to ask you, as the CEO of one of the largest uranium development companies out there, what's going on with the uranium market? Because a lot of people are getting worried after we had that bull market move, the first move of the bull market. A lot of these stocks, GoviEx being one of them, shot up about 5 or 6-fold, and there's definitely been some consolidation on those gains.
No, absolutely. And I think this is a question we in the industry keep asking ourselves as well. The more I kind of talk to other people and we read around, is certainly the sentiment in the market. There was really going to be two ways this market was going to play out. My personal guess at the start was that it was going to be a gradual, slow and steady rise this year, and then would gradually accelerate. And you know, as you know, we've already started talking to some of the off-takers as we gradually start to move our project forward. And we were getting that sentiment from them as well. But they also said there was a very clear indication that we could very easily have one of these scenarios where the uranium price trundles along while, you know, utilities don't quite believe what the suppliers are telling them about long-term supply. And then there will be a fairly rapid realization and that the prices will rise very quickly. And what we're starting to hear from the sort of more educated off-takers is they're moving from where we were, which is yes, it's probably going to rise steadily, to no, it's probably going to just happen all of a sudden and we'll all be caught surprised. And the price will go very quickly, and therefore the utilities will have to react very quickly to respond to it.
One thing to maybe consider in looking at the short-term price of a company like GoviEx is if you do an exercise whereby you go back to 2002 or 2003 and zoom in on a chart like an Energy Fuels or a Paladin, you'll see these pretty violent moves where you have a 300% move and then a pretty strong retracement. But then if you zoom out and look at things over the full 6 or 7 years of that bull market, you don't even see on the chart what's going on. And so getting at the point that, you know, if you're in this for the long term, we're in a bull market now, but there's so much frustration from week to week and month to month on studying the price charts of these companies and getting almost too close to the market.
Well, absolutely. I mean, I think it is a commodity where, because of the way the pricing is structured, there is a lot of, being physics, potential energy rather than just kinetic energy in it. And that really is coming from that contract market as well. I've been talking around to people and, we're saying, look, when you're looking at the market at the moment, the buyers are sitting there going, look, we've got inventory. We don't need to be buying. The spot market is pretty quiet at the moment. We've got our contracts. But at the same time, when you look at that forward contract curve, it's starting to come off fairly quickly. And it's very clear that the big contractors out there, your Camecos of this world are not wanting to play in this market. They need to have a higher price. And I've heard Dave Cates on your interviews before, stating the figure of between $40 and $50 as the all-in price. And, if that is the all-in price to the market, why would anyone want to sell contract material at that price such that they couldn't replace their reserves? Because otherwise they're actually just killing their own company off. And you're starting to see it. And I thought something that was very interesting from Cameco in their last set of results that I heard being sort of commented on was the fact that they were, where possible, they were closing out forward contracts and taking that benefit now. So in that action as well, they're bringing forward those contracts and cancelling them out in the market, which is going to gradually exacerbate this problem where people who want long-term contract are going to have to start thinking about what they really have to pay for it. It is interesting. I don't know if you've noticed that the term price is currently lower than the 5-year price. That really doesn't make any sense to me. And if you're looking for long-term security, you'd expect to see a higher price, and it has historically been at a higher price. So, I do think there's that pent-up energy building up in this market, and I am expecting that rapid recovery to come through.
Daniel, I brought up Paladin and Energy Fuels, two amazing case studies from the last bull market. Paladin's story, famous, of course, by Rick Rule's claim to having bought in at 1.5 cents and riding at least part of that position up to $10 a share for 20,000% gain. And then Energy Fuels, percentage-wise a distant second, but still saw several 1,000% gains. You brought this up to me on the phone earlier in the week, what these two companies have in common and why that makes you so excited.
Yeah, I actually heard another story today where somebody was telling me that they've got a friend of theirs who is now sailing around the world in a yacht because they invested in Paladin in the last cycle. So, clearly there is money to be made. The comment I had to you is if you actually look at the last cycle and you look at the performance, the two standouts were Paladin and Energy Fuels. And the difference between those two companies and everybody else around them was they changed from being explorer developers to being producers. The producing companies did very well. The explorers did very well. But where they stayed, being developers, their performance was nowhere near the deliverable that came through. And a lot of that is because you're effectively, as you can appreciate, the producers tend to get a better rating than the developers or the explorers because they've taken the risk off the table. You've put the real value into play, and that's what happened. And the other thing I would say, and this is something I've gone on about before, is that GoviEx sits at this big discount to its peers because people perceive it to be risky because it's in Africa, and we're like, yeah, but guys, it's similar to a US dollar trade. When people are nervous of the market, they tend to happily hold greenbacks. But, as soon as the market starts to change, they move into the emerging market exchanges. They move to the emerging market currencies because there's a much better place to be. And I certainly, am a true believer that that's exactly what happens in the mining sector as well. People are happy to be owning the safe stocks. But as soon as the market starts to turn, then people are happy to go where the perceived stocks are. But because there's way more upside potential with them. And I saw in your recent note that you pointed out that 3 of the largest transactions that were completed in the last cycle all were actually in Africa. And they're all well over $1 billion transactions on projects and companies that are, in 2 of the cases, much smaller than GoviEx's.
Yeah, and further to that point, different types of companies have different levels of torque. NextGen, for example, had incredible price rise the last few years despite being in a bear market because they made a discovery. But for me, my opinion is there's just no way that NextGen has the type of upside left that it's already experienced. It's already $1 billion company. And then Cameco, as the largest producer out there, is more of a rock, a steady riser, steady dropper, still manages to be somewhat profitable in the depths of a bear market, but it's never going to see the kinds of rises that Paladin or Energy Fuels did. And so what you're saying, just to reiterate, is a company that delivers on construction during a bull market is the one that we can expect to probably have the highest gains by a landslide.
Exactly right. Exactly right. And I, our position and what we've been selling or explaining to the market, more importantly, is that GoviEx is one of the few companies that is already permitted from its project's point of view. It's well positioned. We know what our capital project is going to be. We know what the OPEX is going to be. We've also started that process of structuring our debt and working towards the off-taking. And therefore, it's a company that where we're seeing or expecting to see the supply-demand deficit build. GoviEx is trying to be prepared to be the one that goes into development at that time. And there have been a couple more companies recently get their permits, and that's a really difficult task to achieve your permitting. So, yes, we're very much a company that believes that torque is there. But more importantly, from a pure operational point of view, we see the operational torque is there for us as well to be able to take GoviEx in this environment from being a developer to being a producer.
And here's another thing. I think you would agree with me that people should not be investing in uranium companies if they don't believe in the fundamentals for uranium itself. David Cates, when he came down to the conference, put up this chart that showed that essentially every single development project in the world, when uranium was at $17, $18 a pound, could not make money. And then what we had happen was uranium price moved from 18 to 28 before coming back to 23. That entire range is essentially at a point where nobody's going to make a production decision. So it's almost the same, that it's all just not profitable. And yet stocks like GoviEx went 5 or 6 times just in anticipation of the move of getting to a point where the price made sense. But we're still so far away from that, meaning that the gains these companies can have is truly tremendous still.
Oh, absolutely right. And what David is saying, you and I were discussing just now as well offline. So, but the point that we're doing a lot of work on the supply side at the moment. I think most people out there have a very strong handle on the demand side. And when you look at most of the big forecasting companies and their forecasts, they're all pretty similar. What we've kind of felt is that we had to do more work on the supply side. And because we want to be able to explain and understand this from an offtake point of view, we've done a very detailed amount of work on the various projects that we can see out there. And we've tried to kind of put together a model which, when we're ready to present it, we will. But what we're seeing is really there are 2 main drivers and issues that are out there. One is the incentive price. There are companies that can get away at lower incentive prices, and there are companies that need substantially higher incentive prices to get away. And that certainly is your first differentiator when you look at the type of companies that get out there. The second thing you have to take into account as well, which is, the permitting of a project. And there are companies out there which can get away at lower incentive prices, particularly in North America, but the timeline to get those projects up and running is substantially longer. And therefore, if you think that there's about to be a price run in the next, year, 2 years, there are very few companies who can actually get in and benefit directly from it and create cash flow in this cycle. There are companies that, will get away with a lower price, but they will probably be here 10 years from now, still trying to get themselves permitted so they can become a producer. And I think that's something that the market is still working on as well, that they look at projects that are out there. And I was looking at one supply study the other day, which had a project in it, which they assumed was going to go into production next year. But I know for certain that particular company hasn't even started construction yet. So I'm not quite sure how they could have a project in the supply side that actually hasn't started building itself.
Well, continuing on the line of building a mine, I want to ask you about how a company transitions from the exploration development stage into construction. Obviously, financing needs change from millions of dollars to drill holes to hundreds of millions to build mines, so you have to be able to source that type of financing, totally different groups. The seriousness of execution changes. You can mess up a drill hole, but you can't mess up building a mine, and the skill sets involved totally different. So what are you guys doing at GoviEx to prepare yourself for that next phase?
Yeah, we're doing a lot. We've kind of made it very clear that we've got this 4-pronged strategy, and it's very much our kind of mantra internally as well. What you normally tend to see, particularly in the gold industry, is that a company will go ahead and finish its DFS, and then they will go to a commercial bank with a DFS and try and secure the financing. Because of the industry that we're in, the uranium industry, and because of where we are, we have decided that, what we have to do as a company is to construct a considerably more robust financing package that supports the project and provides the underpin that the off-takers are looking for, because obviously you don't want to commit to an off-take contract when you can't provide to it. And similarly, the debt market isn't going to lend you money unless they know that the risk side of your project is protected by price. So what we have done is start working with the export credit agencies. We are well advanced in that process, whereby the export credit agencies are important because while they're not all direct lenders, some of them are, what they do, though, provide is insurance risk to the underlying banks. So they will provide PRI insurance, project risk insurance, and political risk insurance. They provide commercial risk insurance to the underlying lenders, which allows those underlying lenders to feel a lot more comfortable about lending to your project. So we have a number of banks at the moment and ECAs actually in our data room working, analyzing our company. I think the other thing that it brings out for everybody and all stakeholders involved is that the level of due diligence, because you've got government sovereign bodies involved, is far greater. It takes a lot longer, but the depth of review is considerably greater, because obviously governments are also putting their reputations to a degree at risk here as well. So that is moving along. We're continuing to work on the DFS project in sync with the debt side, so they can see where we're going. I continue to try and push costs down on that project, and then we have already started doing this deep analysis on the market, and are starting to engage with various off-takers of the big tier one size to be able to understand where they see the market going, and certainly where they're sort of indicating us, we're looking for sort of a price around a $50 to $55 floor price. They're saying, they're giving us benchmarks of where we can really start to expect to have a sensible conversation. And it's not that far off where we currently are. As long as we start to see some spot price movement up, then they're very willing to start having a relatively in-depth conversation on future contracting.
Daniel, the Kazatomprom announcement earlier this year came at a very opportune time in the early move up, in that it was a bit of a, I don't want to call it black swan event. People knew it someday it would have to come, but it was a surprise for sure. I want to look forward at what might drive the price next. Everyone's talking about Japan, of course, coming back online, which is this long, drawn-out process, and maybe a couple reactors come back online, but nobody knows the critical point there when it drives the spot price. Are you or Govind or anybody in GoviEx looking maybe for some other type of surprise announcement that could come in the next 12 months? This is pure speculation, of course, but what else could drive the price up?
I think a couple of things will occur. I think one, on Kazakhstan, people will start to realize that the total effect is actually bigger. The thing that you have to realize with Kazakhstan is that their approach to getting a 10% production cut is to stop extending their well fields. So it's not like a gold mine who decides to cut production and just turns a mill off, and keeps the other mill running so they can half their production, or, runs it half time. The Kazakh operations are ISRs, and their approach is, okay, they're like oil fields. You just run them dry, and they're just allowing them to fade off. Now, a couple of things I think there sit within the risk, which is, predicting how quickly a well field can come off. They can go off a lot quicker than you expect them to be. So we may see that cut come down a bit quicker. And I think the other thing you have to remember is that once those well fields are taken off, and finished, the company is then going to have to start considering when it starts putting new well fields back in. And so there will be a time lag at the end of this as well, when Kazatomprom is considering putting new well fields in. And then there will be a time lag while they ramp back up again on the other side. So it's not just going to be a 10% down for this year. It is going to extend into next year at least. And even beyond that, probably as they consider how they want to bring their operations back up to even the existing level. So I think that's one factor that will come through. I think the other factor that we're seeing here as well is the very pronounced guardianship that's coming out of Cameco. You know, they had the issue on TEPCO on the contracts. They're obviously in court with that. But I think what they made clear in their announcements at the last set of reporting was that they reduced their production in line with that and effectively took that production out of their stream. And I think what Cameco is very clearly stating is, by bringing their contracts forward as well, is, guys, you know, we're not going to sell uranium to you guys long term at this price, and we will adjust ourselves to do that. So I think I'm expecting to see more guardianship coming out of Cameco as well. That's going to guide the market. And I think the other thing that will come from that will be, as the market, the utility side starts to realize that if it wants to be securing production going forward, it is going to have to start paying the price. And I think we are coming to a point soon where the contract market will start to lead us forward, and prices will have to go up considerably to allow the big producers and the smaller producers to be able to continue to provide long-term production. I mean, on our own forecasts, if you do not get a price rise, you're going to see production go from its 160 million pound level now over the next 8 years is going to drop to 140 million pounds, simply because there are projects that are coming to the end of their lives and will close because there's nothing left to mine in the ground. And therefore, if that is occurring and the price is not recovering, then where's this production coming from? And the other thing I've noted on a lot of the forecasts as well is there's this decline in secondary coming through as well. You know, as inventory sales are reducing, particularly from the governments. And, you know, some of the forecasts I've seen in the same time period is that secondary supplies are dropping 10 to 15 million pounds as well over that same period. So, you know, if you're going to look at a market that's suddenly going to lose 30 to 40 million pounds of supply to it, that's a big percentage to be dropping off the top without a price move coming in to support production on the other side.
Daniel, let's finish off with GoviEx. The stock is down about 50% off its high, which happened sometime in February, but it's still up over 150% in the last year here. And there's a couple things working short term against GoviEx and all uranium companies, being just the uranium spot prices come off a bit. You also have a pretty substantial financing that took place at 10 cents that closed about 4 months ago. And for listeners that don't know, there's a 4-month hold on new paper issued, so there's certainly some fresh paper hitting the market, which can suppress prices. I think a very interesting buying opportunity, though.
Oh, I totally agree with you. I mean, I'm glad you put the second statement in about where we are from the last year, because yes, we are down from that short peak, but you know, we are substantially up on our long run price. But you know, we have a long way to go in this market, and I think what that price jump showed in January is the potential and the leverage that's sitting there in GoviEx. Yes, we do have an unlock coming through from our December placement. One thing I think that is very comforting in our company is the liquidity levels on our stock. I'm certainly expecting the market to certainly be able to absorb that. We are out marketing at the moment, myself and Govin separately, to make sure that we're getting out to new investors to try and support that market. And I certainly think, as you pointed out, that this is a great buying opportunity. I think the long run fundamentals here are great. I think GoviEx, with its project portfolio and its clear direction towards becoming a producer, are showing that there is a lot of potential. As you said right at the beginning of this conversation, don't get into this sector unless you're going to buy into the commodity. And therefore, you do have to have a degree of patience. But I think all of the stars are aligning very much so in our sector. I mean, the last time we went through $40 was 2-3 years ago. Where else can you have an industry that has been producing at sub its all-in cost for 3 years and not have a price reaction? And I think that's the point. It's being clouded by the contract, but that issue is starting to come to the fore as well. And I'm certainly expecting a fairly quick recovery at some point soon. And, I think we are offering great value, and we certainly have a clear path to value.
Daniel, thanks so much for coming back on the program. For listeners who want to reach out, maybe ask questions directly to the company, where should they go?
They can email me directly on my email address, which is on everything that we put out. It's danielm@goviex.com. I'm pretty good at answering fairly quickly.
Thanks for coming on the show.
Thank you very much. Thank you. Appreciate it.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?